Hello, everyone. Chad Frantzen here, and welcome to the Kingdom Finance Show. Today, we are going to reveal what you really need to know about the economy, the stock market, and real estate. And we're going to give you action steps to take right now to become a Kingdom Impact investor. It's time to bring clarity out of chaos. Let's get started. Hello, everyone. Chad Frantzen here. Thanks for joining us on the Kingdom Finance Show today. Hey, we're excited for today's show. If you want to learn more about what we do at the Kingdom Finance Show and Wealth Builders Investments, please feel free to connect with us online at wealthbuilders.net. And we've got a lot of good resources for you, and appreciate you being here on the show today. We're going to jump in. Today's topic is mortgage rates, and we're going to talk about the interest rate environment and a lot of people asking where are interest rates going and how does that impact mortgage rates, especially for those of you who are anticipating purchasing a personal residence, either first-time home buyers or you're moving out of a current home into a new personal residence. And as many do in our Wealth Builders Network, you're looking at investment property, either residential or commercial, and trying to evaluate what's going on with rates if you're using mortgage or bank money for that. So again, the purpose of our show is really to educate and empower kingdom-minded investors. So people who want to make sense out of chaos. And so there's a lot of chaos in our world today, just with what's going on geopolitically and in the economy. And so whether you're starting out on the road to financial freedom, or if you are well along and at a position where you're really giving and thinking next generation, really our heart is just to educate you on what information do you need to know and how do you apply it. So again, feel free to always connect with us through wealthbuilders.net. We'll be happy to talk with you one-on-one on some of these subjects. So, well, let's dive in. We're going to talk about mortgage rates this week. Again, we're recording this here at the end of April 2023. So certainly we know, just like the stock market and just like the weather, the mortgage rates move around. They change from day to day, week to week. So some of this data is really just time sensitive to when we're recording it. But I think what I'm going to present today will give you some good guidepost as you think about mortgage rates and how that affects some of your financial planning decisions. So, here we're at the latter part of April 2023, and mortgage rates have been kind of bouncing around, but for the most part, pretty stable. The big concept that we need to understand is we have the central banking system called the Federal Reserve, led by Jerome Powell, and they set what's called monetary policy in the United States. And of course, the U.S. is the leading world economy, and the U.S. dollar and the interest rate policies are followed by all other countries, let's face it, whether you're China or not. So we have to really pay attention to what the Federal Reserve is doing. They have raised interest rates 9 times at 9 consecutive meetings, and that goes back to last year in 2022. So they most recently raised interest rates in March of 2023. And the next, what's called FOMC, Federal Open Market Committee meeting, they meet on May 3rd. And the consensus is that the central bank will raise rates again, probably 25 basis points, which is 0.25%. Now, there's interesting comments if you go and read the minutes from the Federal Reserve, which has the committee that makes the decision, and then just the Fed members. There's definitely beginning to be some dissension, or at least opposing thoughts on how much more should we raise rates, and do we really see a recession happen? And the reality is the Federal Reserve does see a recession happening. And because they're so fixated on driving inflation down to 2 or 3%, that they will most likely continue to raise rates or hold rates where they are into a recession. Now, there's a real, what I think is a fallacy of thought out there, and it's this, is that, well, if inflation cools off, then and the economy, runs into a brick wall, that the central bank, led by Jerome Powell, they're going to start cutting rates. And I want to tell you, my personal opinion is that I think that's a fallacy. I do not believe, and there's public comments out there, and stay with me because we're going to dive into the mortgage rates and how this applies, but I want to create a little bit of a framework. I do not see from all the public comments from the Federal Reserve anything to imply that they're going to be cutting rates in 2023. They've publicly said we're going to raise rates a couple more times, which would include the May meeting, and then hold them steady into 2024. So I disagree. The stock market and a lot of market commentators really believe, hey, as soon as the economy runs off a cliff, that the Fed will just start cutting rates. I don't see that happening. Inflation's still too hot, even if it is starting to come down. I think, as I've said in past comments, I do think, historically speaking, in the next couple months, my prediction is we're going to see inflation actually tick back up a little higher. I don't know that it'll go back up to the all-time highs when it was up there, well over 8%, but I'm really anticipating the next couple of months we're going to see some inflation data that's going to show inflation ticking back up a small amount. I don't think it's anything to be overly concerned about, but it's going to go back up a little bit. It's not going to roll over. Inflation is going to be very stubborn, and it's going to be with us well into 2024. So that being said, I think if you're investing or planning based on this assumption that interest rates are going to go down, I think you're going to be left holding an empty bag. Again, that's my opinion. So we want to keep an eye on that. May 3rd is when the next central bank announcement comes. We expect a 25 basis point increase in the rate. What'll be interesting is the comments. So you want to read the minutes. So it's kind of like a board meeting. If you have a church board or a school board meeting, you want to read the minutes, right? And kind of reading what's going on in the kitchen, so to speak. So that's important. That'll be a real telltale sign that the markets, stock market, bond market, commodity market, and the mortgage rate market, which is tied to real estate, is going to be looking at. So I'm going to really present two main thoughts in today's shows as it relates to mortgage rates. The first is what's an ideal mortgage rate, percentage-wise, for what the markets want. And then the second component I'm going to speak a little bit on is supply. And so many of you know, if you're real estate investors or if you've been in the market to buy a personal home, that supply or inventory is everything, right? If you want to live in a particular city or region or zip code, if there's only a couple of houses that meet your needs, well, there's just not a lot to shop from, right? So I'm going to really focus on those two topics today. And I wanted to start just by giving a background on what's happening with interest rates at the government level. Now, the 30-year mortgage rate has been, this week, and I'm just talking national averages, so it may be slightly different because we have listeners from all over the country. So I'm just looking at the national rates, something like bankrate.com. You can go and look at national rates and even rates in your state or region. But 30-year fixed mortgage has been around 6.87. It was last week 6.94. Again, these are just national averages. The 30-year jumbo was 6.94 to a little over 7%. And then 15-year mortgages were lower, 6.2 to 6.27%. So I don't want to get too deep in numbers, but I want you to have those as a reference on some comments I'm going to make. So most homeowners are going to do a 30-year fixed mortgage, right? So some will do a 15-year fixed, or maybe like a five-year ARM, but not so much here to talk strategy on that today, but really looking at the interest rate. So mortgage rates They do commonly track what's called the 10-year Treasury bond and what the 10-year U.S. government bond is paying. It's a good proxy or benchmark for mortgage rates. Now, mortgage rates are a little more dynamic. They don't follow exactly what the Federal Reserve is doing, but certainly they're watching it. And many banks and mortgages will reset their rates intraday, so very frequently on that. Because if it's mortgages, these mortgages are being packaged and sold or securitized in the secondary market to investors. And then, of course, if you're getting bank money, which is different from a mortgage, the banks are looking at what do they want in their own portfolio of loans for that. So 30-year mortgages are still high. They're well north of 6.75%. So kind of close to 6 7/8, 7% in that range on that. So what I want to present to you, again, I'm going to talk about 2 points. Kind of what's the magic mortgage rate? What's equilibrium? If there was equilibrium to where we would see more demand, we would see more supply in that. And I want to present to you that, the changing mortgage rates over the last, 15, 16, 17 months have, these rising rates have led to steadily slowing sales. So if you're looking at home sales, new construction, we did see sales improve, late last summer, July and August, when mortgage rates came back down. And then last fall of 2022, rates went back up, mortgage rates. And that led to, seasonally very slow numbers in the real estate sales market on that. So again, we roll into 2023 and mortgage rates are trending down a little bit, and that helped in the first quarter. You saw some stronger numbers in home sales on that. So the trend, or what I want to call a demand curve for real estate, is really tied to fixed mortgage rates. And I have a chart that I've used, but in essence, the demand curve, as mortgage rates get over 5.5%, so 5.5%, the demand falls off. And as it curves under 5.5, then we see demand going back up. And so when we're in this period where we have generally rising mortgage rates, particularly when they're trending from 6.5 to 7, the demand is going to be lower, right? So that's it's a demand curve on that. And there's a couple of surveys that have been done, and for homeowners and renters that had income over $50,000 of a household income, and these were homeowners and renters. And about 55% surveyed said, this is not a good time to be buying a home. And but there's about 22% who said they thought it was. So the prevailing thought is, hey, my mortgage payment, and I'm talking about for personal residence, not talking about investment property, although the math applies similarly, that rates being what they are makes it less affordable to be buying right now. And this varies by region, but prices are still higher than where we think they should be. There's still some financial gravity that needs to work itself out. I think real estate to work itself out. Could see a 10 to 15% pullback. We've talked about the stock market. Our opinion on that is, with the S&P around 4,000 to 4,200, we think a 20%, 25% correction is certainly on the table, given high rates, high inflation, and a slowing economy. So rate of change at work here. The economy is slowing, rates are still growing, and that is a recipe for a recession and a correction in asset prices. So we call it the everything bubble. A lot of bubbles in asset prices, real estate, stocks, and certain commodities on that. So I really want to present that 5.5% on the 30-year mortgage is the tipping point. I think if we trend under 6% on a 30-year mortgage, we're gonna see sales pick up on that. And another study indicated that close to 2/3 of consumers believe that a historically normal mortgage rate is below 5.5%. Well, that makes a lot of sense because many of us, particularly those under the age of 40 and under the age of 30, have only seen low interest rate environments. So it would be kind of silly to see 7% mortgage rates. Those of you a little more seasoned folks that have been around the sun more times, you know that interest rates have been way higher than what they are currently. So many of you may have bought homes, back in the 1980s, late 80s, early 90s, and you had double-digit mortgage rates. Now, one of the things I want us to understand is that there's also a lot of home builders. So home builders, some of the successful home builders, what they're doing in this mortgage rate environment is they are subsidizing buyers, kind of like a sales incentive, to buy down the mortgage because they realize the data here. And so the national home builders and even some of the regional ones, they're having a lot of success with doing more or less a sales incentive to buy down mortgage rates down to 5.5% or 5% for customers who will buy their new construction homes. So that has helped a lot of the home builders in the United States. And couple that with lower inventories, which I'm going to talk about, has also helped home builders because, hey, gosh, there's not much inventory here, but I see that company X is a home builder and they're building homes, and hey, this is new construction. It's got new mechanical, new roof, everything that comes with a new construction house, right? And they're also offering some incentives to help with my mortgage on that. So, falling construction costs, lumber's come down quite a bit. That's helping the home builders. So some of you may even find, if you're looking, first-time home buyers, or if you're looking to downsize, you may even find connecting with some of the new construction builders in your area, you may be able to find a really good product and with some competitive incentives on the mortgage. But hey, let's face it, real estate, particularly when we're talking about primary residence, it is a use asset, right? This is a consumable asset. We create memories. It is where we take refuge. And so personal residences, although they are an asset on your balance sheet, they're not generating cash flow for you from an investment standpoint. But definitely the psychology of buying real estate for your personal residence is very different than investment real estate, than investing in stocks, bonds, gold, et cetera. So, buying a home it's not all about the finances, and it's not all about timing the market. A friend of mine who's a very savvy real estate investor, often shares a story where he will crunch the numbers on a piece of property, and he can tell just by standing on the curb without going into the house if he wants to make an offer and if it's going to be a good rental investment property. Now, however, when his wife's involved and they're looking at buying a home, second residence, or a personal vacation home or primary residence, you can throw a lot of that out the window because it's more of an emotional, how does this feel? Do I like the layout? And that's what we're talking about here. And so really, a lot of folks just say, hey, they need more space, or they're going to downsize, or they're in transition. So that's still what drives a lot of the real estate market. And that really leads me to my second point here on today's show. Again, we're talking about mortgage rates, talking about kind of the prevailing trend in interest rates. And really, just to summarize this first point, I really think watching mortgage rates, watching how they respond to the Federal Reserve, and when the Federal Reserve raises rates and what they're saying they're going to do as we head into the second half of 2023, I would like to see mortgage rates, and I do think this will happen. It's just going to be, we're going to need some time for mortgage rates to settle back down, hopefully under 6%. And that'll get us closer to equilibrium in the mortgage market. But we're not quite there yet, right? Because we know 30-year mortgages are still well over 6.5%, really trending closer to 7% in some markets. So I want to talk, the second point here on the show is really about inventory. So supply, the basics of economics are supply and demand. And we call this housing inventory. And so there's different sources. The National Association of Realtors, NAR, puts out data on inventory levels. And, it's interesting, here starting the second quarter of 2023, and, the NAR inventory levels for single-family homes are still below 1 million listings nationwide. And so that's very much on the low end of the chart. And so supply is still a major issue. There's another research group that does active listings, active inventory data. So these are not properties that are pending or contingent in any way. And those numbers are extremely low. This data was from first part of April 2023, and this research group, showed 405,000 active single-family home listings, and that's only about 165,000 homes away from the all-time low. So, you want to talk to your realtors in your area, ask them what the inventory levels are. But we're still, even with the seasonality of an uptick in listings, we're still very low. And so in some markets, it's 2 to 3 months worth of supply. Now that's much better than at the peak of the COVID craziness when some markets had 2 to 3 weeks worth of inventory. So still very low on that inventory data. That's something we really want to see improve. Again, it's not that far from all-time lows. It's come up from that, but still historically very low. So again, mortgage rates and the inventory are really the key drivers when we're looking at what's happening in the real estate market. Just to summarize that point on housing inventory, somewhere around 4 to 6 months of available homes for sale or inventory, 4 to 6 months supply is closer to equilibrium. So in some markets, you'll have to kind of check with your, do some research there in your local markets, but some markets are 2, 3, 4 months. Some are higher than that, but nationally, definitely not getting towards equilibrium. So a seller's market versus a buyer's market, when there's low inventory, just as a reminder, it really is a seller's market, right? Because there's only a fixed amount of product, right? And so the seller can control a little bit more terms, pricing, because of just this supply and demand concept. So again, we get into 1 to 2 months, 3 months worth of inventory. It's very much more a seller's market. Now you get up to 4 to 6 months, you're approaching equilibrium, where it's a little bit more, let's say, a fair fight or a fair negotiation because there's more supply. Now you get 6 to 9 months of housing inventory. We're talking single-family homes, and then the pendulum swings the other way. It becomes a buyer's market, and so the buyers have more control over pricing, terms, and some of the details of a contract. So we're far from that. Now that being said, you want to keep an eye on listings and days on market. How long, certain listings in your area that you're watching, Some of these days on market are starting to tick up a little bit, and some sellers and builders are doing minor price cuts if it stays on there 30 days. Now, that being said, from my experience and talking to a lot of real estate professionals, if it's a high-quality home with nice finishes and it's in the nicer neighborhoods, it's not the most expensive house in the neighborhood, but it's going to be B+ to A- finishes, and it's just really well done. Those are still going to command a high desire because there's typically less of those on that. So again, really, the other point, and some of you may be doing this, a lot of people who own a home and they've lived in it, and maybe they've outgrown it and they're going to move to a little bit bigger home, or they're going to change jobs or move to a different city or state. Instead of naturally just selling their homes, they are keeping them as a investment rental property. And I can't say I blame folks, because if you have a house and you've got a 3% mortgage on it and you've just outgrown it or you're relocating, you can probably make the math work, because rental market is still very strong. And even in a recession, rental market is strong. And if you've got a 3.5% mortgage on it, you can probably make some meaningful positive cash flow by just renting it out. Now, many people will need to sell that primary home to get the equity out and go buy their next home. But there are some people that are doing that. And what that means is it might make financial sense for them, but it's less inventory on the housing market. So anyway, those are my thoughts just in kind of concluding here. Again, looking at supply or inventory, I use those words interchangeably. That I really want to be watching that. And then mortgage rates. I really think equilibrium is closer to 5.5%. I don't think we get there for a while, but that's really, I think, the magic number on the mortgage rates. So I hope this has been helpful, whether you're just evaluating, watching mortgage rates and real estate for your first-time home buyers, or you're looking for a new personal home, or as many of you are, investors that use mortgage money or bank money, and you want to make the best decision with that. So, hey, as always, thank you all for being here on the Kingdom Finance Show. Again, our goal is just to empower you to get clarity out of chaos and apply biblical principles to the management of your resources, but also how you impact the kingdom for God's glory. So thanks for being here. Feel free to check us out online at wealthbuilders.net, and we'll see you next time. Thank you so much for joining me today on the Kingdom Finance Show. If you enjoyed this podcast, please subscribe and leave us a review. It really helps to get the word out. For more resources on becoming a kingdom investor and to connect with us directly, visit our website at wealthbuilders.net. That's wealthbuilders.net. We'll see you next time on the Kingdom Finance Show.